back value through connecting professionals all around the world, especially the Pakistani diaspora overseas, who can take it to the next level as one of the most exciting emerging markets when it comes to this space. Our panelists today, I'll just do a very brief introduction because you have probably read about their profiles on our introductory page. So we have Mr. Khurram Zafar, who is currently director of 47 Ventures. He's a published author, entrepreneur, and an avid venture capitalist. He has been involved in a number of different positions, including the Prime Minister's Task Force on Technology-Driven Knowledge Economy. He's a board member and a director at Karandaaz Pakistan, and also Mobilink Microfinance Bank. Thank you, Khurram Bhai, for joining us today for this session and sharing with us your experience and knowledge. We also have Salman Khalid, who is an emerging markets, mergers and acquisitions, and private equity specialist. He also has a keen interest in angel investment in technology-driven startups, particularly in Pakistan, but also elsewhere. He's currently leading the consumer, retail, and services and industrial verticals for a major investment bank. He's in the Middle East Africa region currently, and his specialties include venture capital, strategy, and public policy. Salman is a Fulbright scholar who has an MBA from Georgetown University, and he's also studied at LUMS, before which he had an electrical engineering undergrad from UET Lahore. Thank you, Salman, for your time as well. So we'll kick off with something very simple. We have received a few questions from our participants, so we will be going over them in the next 45 minutes or so. So maybe, Khurram, I start with you. Just define for us, so for some of us laymen who are relatively naive, that when the term angel investing is used, we also heard other terms like VCs, venture capitalism, syndicates, etc. Just share with us a little bit of how you define angel investment, what is the origin of this term, and how does one become an angel investor, size of investment wise or other aspects.
First of all, thank you very much, Amir and Ali, for creating this platform and giving the opportunity to be part of it. It's a privilege to be here. So angel investors are all the good-looking people that are very rich and want to invest in startups. At least that has been my experience here in Pakistan. No, so in all seriousness, every new business, a new venture, goes through various evolution stages, and before a company or a startup is ready for institutional investment, and could be a number of reasons, the level of maturity being one of them, the time they've been around, the kind of traction that they have to demonstrate in order to conform to the investment thesis of an institutional investor. They do need capital. A lot of the times, investors, if the sponsors of the company or the founders, if they're wealthy enough, they're able to pull in their own resources and get the company off the ground and ideally get it to a stage where they can raise some institutional capital. But oftentimes that is not the case, particularly in Pakistan, for example. A lot of the founders do not come from backgrounds where they can afford to pull in this startup capital into a business. So what they do is they reach out to either friends and family, or they reach out to individuals, wealthy individuals, high net worth individuals. And there's really no, in Pakistan at least, there's no definition for it. In US, there's a proper accredited investor criteria that makes you an angel investor, but not in the case of Pakistan. They're generally rich people who ideally can, one, give you some investment to get the business off the ground and get to the next stage where you can reach out to institutional investors. But more importantly, add additional value aside from capital, whether it's guiding you, mentoring you through the process of creating a business, or creating your product, or opening doors for you, or maybe even creating connections to other institutional investors when the company or the business needs more capital. So those people are called angel investors, and that process of investing very early stage risk capital into a business that typically companies, aside from money, the skills and network and experience of those individuals, is called angel investing.
Wonderful, thank you very much. So Salman, I mean, we still just stay in the definition zone before we go into the main themes of how do we evaluate and so on in the as angel investors. Now, some of our attendants today, they have asked question about coming across different funding rounds. And one of those rounds is referred to as the angel round, but there are also other terms used like bridge round, pre-series ABC, there is seed and pre-seed. And sometimes what I got from the questions themes was it's a bit confusing that same startups who are relatively at the same stage might be using different terms for them. Could you just, for the basic knowledge of our attendants today, attendees today, let us know what do these different rounds mean, and in the journey of a startup, what is the normal sequence, understanding that there must be some interchangeability across these terms. Because within them, there is an angel round as well. So is there a specific time when an angel investor can enter the fund round, or could it be more broader than that? So a few more definitions for you, Salman.
So I think I'm not surprised that people are confused because when it comes to VC investments, I think it's almost like 50 shades of gray in terms of how people define them. So I think you can approach this question, theoretically from 2 or 3 angles, right? One is, what is the stage of the company itself in its product development and market acceptance? That's one. The other is, what is the quantum of capital they're raising, and from whom they're raising it from. And if you think about it from that perspective, I mean, I would say whenever you're bootstrapping a company or you're starting a company, right, pretty much what often happens is you go to your 3 Fs, and 3 Fs would be friends, family, and fools. And that would be your first source of capital pretty much, right? Angels pretty much, I would say, are like on the border of starting from fools onwards, where the company maybe is just beyond the initial idea stage, and now you want to start going to external parties a little bit and start raising capital. Now, at this stage, basically, you have maybe a very early stage prototype or maybe an idea, right, which is maybe you're working towards, but you don't have anything credible at that stage. And often you would call this maybe a pre-seed stage or even an angel stage, theoretically speaking. So you're talking about smaller quantities in terms of capital that you're raising. You have a product which is very infantile at that stage. Your market acceptance or credibility is pretty low at that stage. So the amount of capital typically you're raising at that point is small. Your valuations are smaller. And again, people will throw out numbers that what is the quantum of the capital you're raising or what is the valuation you're raising in that at that round, but it varies from market to market. So it's difficult to actually say that this is the range in the US and that will be applicable in Pakistan. It can vary. So I would say pre-seed and angel round for me would be the first stage where you go beyond your immediate circle of friends and family or fools, and you start raising capital from external parties. And immediately after this is sort of the seed stage, where basically I would say you're at a minimum credits or minimum prototype stage in terms of your product, and now you want to start you start getting some sense of the market acceptance of your product. So that's pretty much your seed stage of capital. Now, as you go up higher and higher, the more and more capital obviously you're raising, and the more and more valuations increase because you're slightly de-risking a little bit each time you go forward because you've established the product, basic prototype. There's a basic acceptance of your product that's established. And now typically historically used to have the seed stage and then used to go to Series A. Now people have sort of bifurcated that bit in slices as well. So you have a pre-Series A or, as well. But I would say generally Series A to start with is essentially when you have, you have now some reasonable amount of acceptance of your product. You have demonstrated there's demand for it. And you have the nucleus of a scalability showing up. And that's pretty much Series A. And that's the point where I would say things start becoming more interesting and more institutionalized capital starts coming in. And you have people now at this stage looking from both the VC's perspective and more, as well as maybe the bigger tickets from the angel investors side as well. Similarly, as you go beyond Series A, then you go Series B, Series C, and I've seen companies doing Series Fs and God knows what. But basically, as you go higher and higher in that maturity, product acceptance, scalability, market expansion, you raise more and more rounds, and then so you pretty much go through the entire alphabetical order. But I would say you should not get stuck up too much about the terminology around this. I think generally when you're talking about Series A, when talking about seed, pre-seed, generally it's early stage company, which is with a prototype product, just has a little bit of veneer of acceptability for their product. As you're going towards Series A, you're now have increasingly demonstrable acceptance of that product, and you're raising larger and larger capitals. I would say in Pakistan, if you look at a couple of rounds recently, you would often see that people are raising about let's say a $2 or $3 million valuation for around seed round, and they would be raising about $500,000 on average. And from the Pakistani perspective, as soon as they start going to Series A, now you're looking at valuations which are, I would say, closer to pre-money, let's say $8-9 million, or and they're looking to raise about $2 million or more. So I would say that's a bit of a quantum jump in between. I hope it sort of reduce the confusion a little bit, but at the end of the day, I think this is not people use these terms loosely, I would say.
Amir, for me, I just want to add to what Salman has said, and I totally agree. I understand why there's confusion about this, but and I agree with everything that Salman has said. But I just want to add, from an investor's standpoint and from a practical standpoint, the thing to understand and thing to watch out for is how, depending on what stage you are coming in as an investor, how the rounds or how the financings stack up in terms of their preferences. That's one of the most important things that you need to understand as an investor. B over A, C over B, D over C. How do the preferences stack up? And when you sort of peel it all off, whenever there's an exit in the company, what is it that you get out of it? So one, you need to understand from prior financings that have happened, how the preferences stack up. And these could be both economic as well as control preferences. And second most important thing is, how does the cap table evolve based on the financings that have happened in the past and the financings that are going to happen in the future, and where you would fall eventually when there's an exit, and you can sort of make this very liquid investment something that gives you a return. So those are the two practical things to watch out for, and what really matter, regardless of what you call these successive financing rounds.
Sorry, I was talking on mute. We do have specific questions on cap table and exit, so I'll come to that, I think, a little bit later once we have gone through the process. But this is good that even at the definition point, so I think what you're saying is, in addition to the parameters you just defined, and we will elaborate on shortly, an angel investor, as long as the founders are open to taking angel investment, it doesn't matter which round it is in. But I guess progressively, as the bigger rounds come or bigger valuations come, the investor's profile probably changes from angel to VCs and so on. Will that be a fair way of describing it, directionally speaking?
Yeah, so generally angel investors would participate in a C round, or maybe put some money into a Series A round. I've very rarely seen angel investors, unless they're filthy rich and they have a large allocation of capital towards this broader, private equity, venture capital asset class, a high risk asset class. They generally wouldn't go beyond that. But generally, once institutional investors start coming in, it's sort of their game from there on out.
Right. Okay. So let's go into the crux of this investment. Is it a qualified statement? Like, if people want to be angel investors, it's a very happening space right now to be part of these startups, usually led by young people, a lot of energy, a lot of new brilliant ideas, technology involved. The key word here also is investment, right? Many people, whether they are high net worth individuals or otherwise, they all of us have different segments of investment portfolios in our mind. So the risk profile of every individual is different. On a scale of 1 to 10, when we talk about angel investors, and as you just described, they're usually in the early round, when it's early days for a startup, what would be the risk profile typically on a scale of 1 to 10 for an angel investor compared to, let's say, more typical vehicles like mutual funds or real estate or the normal bottom of the pyramid kind of investments. Maybe I ask Khurram bhai you to comment first, and then we go over to Salman for his views.
Amir, I think angel investment, it's not just an investment. I would always preface it by saying it's a high risk investment. In fact, it's a very high risk investment. I think if you just look at the numbers and data, they'll be very close to gambling. Just shy of the risk that you take when you gamble. So it's that high risk. Now, you can obviously try to mitigate as much of the risk by being very careful when you're making your investments, by making investments in areas that you understand, in industry that you understand, where you can open doors and deliver a lot of value other than the capital that you're adding into a company. But regardless of what you do, investments in startups and in new businesses generally is very risky compared to every other asset class, especially the ones that you mentioned, bonds, mutual funds, REITs, real estate, in general. And then within the new venture investments or venture capital investments, angel investment is one of the highest because you're putting the capital in very early in the life of the business, oftentimes at the very conception stage. So the risks are very high, and they generally translate to cheaper equity. You generally get a lot more equity for the same dollar that you're putting in at that stage compared to somebody who comes in at Series A stage, for example, or pre-Series A, whatever you want to call it. So it's a very high risk asset class. Generally, the rule of thumb is what investment advisors would advise you shouldn't have, perhaps more than 5%, or depending on if you're very young and you have a very steady alternative income stream, maybe 10%. Maximum would generally be 15% of your risk capital allocated to the venture capital, private equity, hedge fund, angel investing asset class.
Great. So I think when we talk about the very high risk, obviously, if somebody is new to the arena, they are naturally attracted to the energy, to the technology, and all these other parameters, all other variables that we see. And one of the main things, and you can see in the chat box also, we're getting some interesting comments. I'll try to bring them into the conversation. So Salman, Khurram bhai has already elaborated that this is not just high risk; it's actually very high risk. The trade-off or the return on that is you get equity much cheaper. So if really the startup makes it, you stand to gain more because you're betting at a stage where not a lot is known. Normally, when individuals would make an investment, they would have some material available, right? It could be cash flows, it could be income statements, it could be Wall Street or any stock exchange reports. So in the case of a startup, when you are at that angel stage, pre-seed, seed, as we just discussed, how does one evaluate the risk? It is high risk, that's established, but then if you want to invest even a small amount, what would be the, let's say, top 3 things, agnostic to the sector that you're in, that you would advise an angel investor to ask those questions, or at least seek that information to start building a picture of how much of a risk he or she is taking?
I think irrespective of whatever sector or investment you go for, you have more chance than not that you will lose all your money in that investment as an angel investor. I think that's the first thing you should keep in mind. Now, how can you potentially reduce the risk of losing all your money? I think there I would say 2 or 3 things you can look at in particularly, let's say, in an investment, individual investment, but also I think I would always say to somebody, as the old saying goes, don't put all your eggs in one basket, first of all, which means that build a portfolio of smaller investments if you want to do this thing, rather than putting a lot of money in one individual investment. Now, which often would mean that you maybe invest collectively as a group of angel investors across multiple investments to reduce your risk overall on a single investment. Now, when looking at individual investments specifically, I would say, for me, the first and foremost, when you are coming in as an angel investor, you're pretty much in an early stage of the company. And often they would not have much to show for what they've done so far. You're really betting on the quality of the team, first of all, I think above and everything else. So, which means that the people that you're investing with are these people who are smart? Are they hardworking? Are they credible? Do they know what they're doing? In a sense, the market they're trying to attack, do they understand that market? At least are they thinking about the right things to attack the problem they're trying to attack? I think that for me is the first sort of litmus test looking at any startup early stage. Number two, as an angel investor, at the end of the day, the question really is, are we making money? And to answer that question, I think you have to think about the market, the problem the company is trying to solve, right? At the end of the day, is that a problem which is big enough? And is the business model interesting enough to actually scale up quickly, or in a way in which it can actually make money for you? So you might have the best team possible, and you might have a great business model, but it might be in a market which is so narrow that you don't have the ability to actually ever scale up and become something big. So you might be taking a high risk on a company which has very little chance to actually ever make money for you. So is the market big enough? Is the business model of the company the right model to actually scale up to a point where you can actually make money or not? But at the end of the day, I think the first thing would be really, is the quality of the team. Because what will happen often with these companies is they will pivot as they grow. They will come across challenges, they will hit roadblocks, and can they actually, as long as there's a smart, dedicated, hardworking team behind it, they can make adjustments to suit the problem they are facing. But what you cannot solve for is then, if you're betting your money on the wrong team, that's something you cannot come back from. You can always adjust your business model. You can also even pivot your target market a little bit as well, depending upon what you come across. But I mean, that would be the key. So those were the key things for me early on. Interesting, good team, solid team. Number two, interesting business model which can scale up. Number three, the market they're attacking is big enough for you to make money. And at the end of the day, you make money when there is an exit. So what is the exit? Long-term exit. And often people will have strong opinions over here that you should not look at exit early on. But at the end of the day, we are in the business of making money. When you're coming in as an angel investor, it's fun and all exciting and all that. And a lot of people just get swayed by the whole aura of angel investing that it brings. But at the end of the day, you're there to make money. So is this a business model? Is a segment which you think at some point will attract enough interest for somebody to come and buy you out? I think you should think about those things going in upfront, in my opinion.
Amir, if I may.
Yeah, I was going to come to you, but I thought if you allow me, I want to add one spin to it before coming to you. So one was, of course, please add to what Salman's perspective is. But he raised one point, which is also in our topic list in terms of market size and business model, right? Now, one question that has been coming up is in emerging markets, a lot of the pitches start by impressing with big population numbers as the basis of projections. Right, 220 million people in Pakistan and Egypt and Saudi and a number of other places, and then some very big macroeconomic indicators. And many times it is difficult to even validate. When you talk about broadband penetration or some of those some big very fancy buzzword statistics. So Khurram, as you're building on Salman's point, could you just give us a few pointers on how to filter through statistics which may or may not be necessarily easy to validate, and other than the normal laughing test one would apply, because many people are away from Pakistan for several years who are in that angel investment interest bucket now. How to navigate that space where a lot of stats have been thrown at you about the market, about the opportunity, and you have very little to cross-reference whether those numbers are actually in the ballpark or not.
Yeah, that's a good question, Amir, and let me circle back to that. But I just wanted to add a perspective to what Salman said. He spoke about scalable business models, and a lot of the times I've seen angel investors, they make a very critical mistake. If they are looking for, let's say, angel investor being a high-risk asset class, you typically be looking for in a country where risk-free rate is around 10 to 12%, you generally aim to make at least 25%, maybe 30% on your high risk, asset class, the money that you've allocated to this. And if that is the case, oftentimes when they're evaluating startups, for each of the startup, they'd be looking for that kind of return. But that's one of the biggest mistakes you can make. For example, if let's say you allocate $10 to your angel investment portfolio, and as Salman alluded earlier on, the prudent thing to do is to diversify and let's say invest $1 each into 10 different startups, right? So now you've done that. Now, in order to be successful, you need to turn your $10 investment into, ideally a $30 investment, right? And at the end of the 5, 6, 7 year, maybe 8-year investment horizon, if you turn $10 into $30, then you've done well with your angel investment portfolio. Now, what happens is if you invest in each of the business and you look for a 3x return potential, because that's what you're looking for at a portfolio level. You want to turn your $10 into $30, so you're looking for a 3x return. But if you're doing that for each of the startup that you're evaluating, then what will end up happening is your overall return is going to be a lot less, because not each of your 10 investments is going to succeed, right? In fact, chances are that 9 out of those 10 will be a wash, or few will barely return the capital. So you'll have one home run. But since you don't have a crystal ball and you don't know which one of the 10 investments is going to turn that $1 into the $30 that you need at a portfolio level, then each of the investment that you're evaluating, you need to ensure that it has the potential to turn your $1 investment into the $30, because all the 9 other dollars that you invested in 9 other companies are probably going to be a wash, right? So that's a mistake that's very commonly made. So you need to sort of understand what is meant by a scalable business model. A scalable business model is not something that turns your $1 investment into $3. A scalable business model, or the size of the market they're going after, the business is going after, should have the potential to turn your $1 into $30, because that $30 is going to be the entire return on your $10 of investments, right? So that's a perspective that I just wanted to add. I'm just giving ballpark numbers. Obviously, everybody has a different thesis for their portfolio. Sorry, what was the question that you had asked? I lost.
The size of the market and how to do the litmus test on assumptions which come in big numbers and big macroeconomic numbers.
Yeah. So this is unfortunately, unlike many other markets, this is one of the challenges of operating in Pakistan, because we don't have reliable data. We don't have gardeners or foresters doing these research that can feed into your either top down or bottom up analysis and sizing of markets and such. And it is a real challenge. But the answer to that is not to sort of discount everything heavily, because Pakistani market can very pleasantly surprise you also. I love the story of a Multan entrepreneur who basically started from his house after selling motorcycles, selling candies and biscuits from a mohalla, and has grown that into a business that has around 30 billion in sales, right? And that's a testament to the potential of the Pakistani market, especially the consumer market in Pakistan. It is huge, it is immense, but you have to make sure that whatever business model you're pursuing, one, the product is good, it'll be desirable, it addresses fundamental problem of the consumer, it is priced right. Number 2, number 3, it's distributed right? So as long as that is the case, you can, particularly for consumer-based businesses, you can bite some of those numbers that are presented to you by entrepreneurs. But you don't have to take them on face value. You obviously discount them as based on your knowledge and experience. Oftentimes in several industries, you will find very reliable data. And in that case, you can leverage that data. You can look at comparable markets like India, like Indonesia, perhaps which is a closer comparison to Pakistan, or some of the other markets where data is available. Then you can discount it for the Pakistani market, or the size of the Pakistani market. So there are ways of doing that. Probably the easiest and the lowest hanging fruit that we have used is to not buy those assumptions, but talk to an expert in that industry, whichever industry that the startup is planning on operating in. You just talk to a guru of that industry, and they'll have some good, reliable data for you that you could have more confidence on, as opposed to something that was put in a slide on a PowerPoint presentation.
Wonderful. Okay, I'll come back to actually the presentation. Back to you, Khurram, in a minute. Salman, you mentioned something about hedging risks by pooling different friends or like-minded people, and I think the word that we've heard around is a syndicate, and another thing called an SPV, a special purpose or single purpose vehicle. So for those of our angel investors who are still a bit intimidated by the high risk nature, but they still want to have some play, whether it's about dividing that $10,000 across 10 startups, or whether just trying to get bigger ticket sizes with friends. Can you just articulate for us very briefly what a syndicate is, what an SPV is, and when people enter into those vehicles, whether they do with friends or sometimes with strangers, what to watch out for in order to do it the right way, the legal way, etc.?
Yeah, sure. So look, I think here is the challenge. You are going and investing in an extremely high risk asset class. Most of the companies you will invest in will fail, and it's in that there is a high level of certainty that the most majority will fail. So and most of us don't have enormous amount of capital to invest in lots of companies. So how do you solve that problem? And typically in finance theory, you do with portfolio building, and the portfolio building here is slightly more challenging than, let's say, in a public, listed equities market, where you can go and buy an ETF and you already have a portfolio available. Here, typically a ticket that any startup will take, generally, there will be a certain minimum size often. And minimum size typically will be around $25,000. Sometimes it's a bit less, sometimes a bit more, but generally I would say that's a ballpark number. Now, most of us cannot put in $25,000 over 10, 15, 20, 30 companies. So one way for you to sort of overcome some of these challenges, like, so for example, what I have done with some of the people I know, is we form a syndicate. Syndicate essentially a pool of people who decide that we are going to invest collectively together. And the way you do it, you can do it in different ways. Some of them will, what we have done, for example, is we have established an investment holding company in the Cayman Islands. Some people will establish it elsewhere. Someone will establish in Delaware, some in Singapore. They have different costs for establishing. So you can also probably do it in Pakistan, right? So depending on wherever you want to do it, you can do it. You can establish a small entity for investment holding. It can be an LLC. If you want to do it outside Pakistan, Cayman probably is one of the better options with not a lot of costs. It costs you around $2,500 roughly for initial setup of an LLC. Running costs another is $1,000 per annum, roughly 1,000 or more, a little bit more. So if, let's say, you have 10 friends who collectively put in $25,000 each, all of a sudden you have $250,000, which you can deploy over 10 investments, and you all get exposed to 1/10 of that investment, of each of the investments, which is a lot better than one guy going in and putting in $25,000 in one company. So essentially, it's portfolio diversification, right? Now, risks associated, the other way some people do is they just have an agreement, and basically they say, well, we will sort of invest together maybe through one person, but then we all can have this agreement with this person that whenever he exits this investment, we have pro rata sort of stake within that investment. That might become a bit messy, I think, if you're leaving it to one person holding all the shares at some point. But people are different, comfortable with different level, different structures. Now, what you should think about, I think, really, when you're going into these syndicates, is whom you're syndicating with, first of all, because at the end of the day, I wouldn't advise, first of all, building syndicates with people, very large syndicates, first of all, because it can become messy. Number two, I wouldn't advise building syndicates with people you don't really know much. And thirdly, I think when you are eventually establishing a syndicate, you need to have, I would say, upfront, very clear guidelines in terms of decision-making process for the syndicate, which should be in form of the legal document. Because tomorrow you may have a difference of opinion in terms of whether to invest, whether to exit on certain investments. Who is going to represent that syndicate, for example, in front of a certain company? How decisions are going to be of the syndicate? How are they going to be transmitted? So on and so forth. So have everything cleared upfront in writing in a legal agreement, in a legal form. Probably better in my view to, if you're going to do it through a legal entity like an investment holding company, an LLC, where depending on whatever jurisdiction you're comfortable with, you can use that jurisdiction. As long as you sort of look at it from a tax perspective as well. I mean, it should not be a very it should not be a very expensive locality from a tax perspective, depending on where you are looking to invest.
Very clear. Khurram, we are getting a couple of interesting questions which probably dovetail into this conversation. They're around regulations. So in Pakistan, and I know you're into venture capitalism and you advise a number of people on investment. Are there any regulations regarding angel investing in Pakistan, something the equivalent of accredited investors in the US? And is there an efficient way? This is part B of a question by Salman in our chat box. He's asking, is there an efficient way to reach accredited investors in US? So two parts of the question: regulations in Pakistan, if you're angel investing as an expat or local, what to look out for. And then second part is, how can we reach accredited investors if we are interested in angel investors from outside like US?
That's a good question, Amir. Look, yes, there are regulations. The brief answer to that question is, in fact, the regulations have evolved and gone through a process of maturation over the past, 10 years or so. The first draft of private equity and venture capital regulation was very draconian. It was essentially, VC funds or PE funds or angel syndicates were perceived to be just like, madarbas and mutual funds, which would, typically have a very liquid underlying. They could, price the fund every day and market to market, every day if need be, and the reporting requirements were spec'd out to be that way. There was no consideration for tax efficiency in those structures. But bottom line is now they've gone through a process of maturation, and lately the last amendment that was made, I believe last year. I'm not a tax expert, so don't take my word for it. Always consult with a tax advisor. There's now a recognition of both angel investors, angel syndicates, private equity funds, and venture capital funds, also lumped under this private fund management regulation, the private fund management companies. So, and there's criteria. There's a minimum capital criteria for these funds. There's a limitation on who you can solicit capital from, and the amount of capital that minimum capital that they have to invest into a vehicle like this. And there are criteria about the minimum capital that the sponsors themselves have to invest in the fund. And then there's some gray areas of tax treatment and capital gains tax treatment, for which FBR will not give us anything in writing. So it's, you'll be completely going on faith because the language is very convoluted. So I don't feel comfortable commenting on it. It's best to get legal advice, formal legal advice for that. So to answer that question, yes, SCCP now recognizes this asset class and fund managers and private funds, and they're trying to regulate it and provide some sort of broad operating system in which they can operate. The second question was around creating these syndicates or accessing angel investors in other markets like US, for example. Yeah. So I think the best mode for that is just networking. And I think you guys have all done a fantastic job with Park Launch, and it has been a tremendous platform that has been a stepping stone for a lot of the entrepreneurs, as well as local investors, to connect with high net worth individuals and Pakistani diaspora outside of Pakistan, particularly in US. And I don't know the latest numbers, but there are now several investments that have been made through connections and introductions that have been made through the Park Launch platform. And Park Launch is a great platform, but there are other platforms like this that you can connect with, you can network with, and you can reach out and solicit help from. Then there are formal, more established ways of reaching out, sort of the non-diaspora or the broader market out there. There's angel list, for example. They're actually formal syndicates that have been structured formally. Oftentimes it's as simple as accessing a website and adding the profile of your business. It gives exposure of your business to a lot of the investors who are accredited investors and can make those investments. But frankly speaking, things are changing, and I hope they change even quicker. But right now, it's not as easy to solicit capital from people who are not associated with capital or don't have the same level as conviction, and perhaps some of the Pakistanis who have done well outside of Pakistan, because typical Gora Silicon Valley investor would have the entire world to invest in, right? So before you can sell your business model, you have to sell them on Pakistan compared to maybe Indonesia or Vietnam or India or any of the other large markets, for example. But things are changing. There's some of the recent capital that has started flowing into Pakistan, particularly from blue chip investors like Kleiner Perkins, for example. I think that validates the potential in the Pakistani market in a big way, and that will open the wallets of a lot of other investors, both institutional as well as individuals and angels, to take a risk on businesses in Pakistani market. It's all out there. There's no secret science. There's no silver bullet. There's no phone number you can call 1-800 connect me to an angel investor. Raising capital is not an easy job. It's a full-time job of a CEO. When you get into the fundraising mode, 4 to 6 months have to be consumed by that process. And oftentimes I've come across founders who expect that since they're doing well and they think that their business is amazing, they should have to make a few phone calls, send a few emails, and all the money will start coming in. All the stories that you hear in media, that's the finish line, right? That's the highlight of the entire process. It doesn't. In fact, in most of the cases, it doesn't document the struggle that the founders go through. So I think if you work hard enough and if you put in enough time, effort, energy into it, you can raise money. And there are plenty of platforms like Park Launch out there that you can leverage, to make the process easier.
I think that's a great point, and thanks for bringing it up, Khurram. Park Launch, for those of you again who are joining us for the first time at an event, I think our last running total, and we are a relatively young platform still, already over $4.5 million of investments have been enabled, primarily through angel investors and small syndicates behind closed door fundraisers that we do. And because we take a lot of pride in being the connecting platform for startups, investors, and experts alike. It's not just the money which is changing hands. There's a lot of expertise that is out there. So we've got some of the most outstanding people, including our panelists here on that platform. Very welcome to browse around our website, and if you want to join in as a member, that also opens doors. And as Khurram said, there are many other platforms where it could be. But there's a lot that still needs to be done on selling Pakistan. I think that's also a big takeaway I took from his answer. And even on those lines, I think while there are many different groups and organizations doing that marketing on behalf of the country and its talent, I think Park Launch is also looking for something coming up later this fall, so something to look out for. Salman, you described a little bit about what to look for in the pitch of founders when you are being an angel investor. Now, we also have a few startup founders and their team members on call today. If we just pivot a bit, and let's say now we wear the hat of the founders, and now you have to raise early round money, still small quantums, but you are up against people who are not very skilled at assessing startups. What would you advise them? I imagine it will be similar things that you're advising the angels to look out for, so the founders should be sharing the same. But if you had to give 2 or 3 consistent ideas that different founders can take up, that if they are up pitching for half an hour, 20 minutes to angels who may not have very specific targeted questions, what should they include in that brief pitch that will deliver at least the main crux of getting the message across?
Sure. Look, I think first of all, there are two parts to it in my view. I think first of all, what kind of investors should you look at when you are a founder? And I think you should look for smart money. First of all, when I say smart money, I mean people who can add value beyond money for your venture, because often what you would have is founders who are obviously passionate and entrepreneurial, but often they may not have the obviously all the networks that they need to grow. Neither they may not have all the experiences they need to grow. And often having people who interests are aligned early on with you because they've invested capital with you, but also have a lot of industry knowledge or connectivity, maybe in terms of operational know-how, maybe in terms of capital raising know-how, maybe in terms of introductions. That kind of value is, I think, much more valuable often than just pure capital. And often I think that's an important thing founders should look out for when they're looking for capital. The other bit I think is when you're actually pitching to somebody, I would say there are 2 or 3 things for me which were really important. I think is, first of all, what problem are you solving? How are you solving it? And often when you one mistake which I see early, like people, founders, especially early stage founders doing, is that they would go into an entire trajectory with lots and lots of details because they're so excited often about what they're doing that the key message sort of drowns in the process, and you actually end up coming out no smarter than you go in. So I think just think about what's the core, what's the problem, why is that problem the problem you want to solve, and how are you planning to solve that problem, and why do you think this from an investor's perspective it is attractive, because at the end of the day they are investing in your company to make money. So is there a roadmap, a credible roadmap, that there is some light at the end of the tunnel, that there is a possibility for them to make some real money out of their investment? Because at the end of the day, if you put them in your shoes, they're investing their personal money in a very high risk venture, right? So you need to be able to explain to them in a couple of sentences what you're doing, why you're doing it, how are you doing it, and where is this venture going, right? And often I think the people may be able to explain bits and pieces of maybe 1 or 2 or 3, but then they forget about the last one. Is like, okay, I'm here today. So, okay, so how are you going from here to wherever you're trying to go? And it doesn't mean that you should need to know everything today, but at least what for me is important thing as an investor to look out for is that the founder is actually thinking about things properly. He may not have all the answers today, but I want to see that process in his mind going on. That he's somebody who at least is trying to understand the challenges he's facing. He's not underappreciating some of the challenges he's facing, right? He is not selling me pie in the sky at the end of the day. And often I've seen pitches with everything, I'm doing great, this is GDP growth rate, this is that. And at the end of the day, there's no business plan at the end, not even a veneer of business plan. And you ask them, okay, guys, you're saying you're going to grow by 10x in the next 1 year or 2 years. How are you going to go 10x in the next 1 or 2 years? And often there is silence, or they will give you some such a fantastic response, and that you lose all credibility immediately. Now, I understand that you would often not have the answers, and nobody will have a lot of answers for a very early stage, fast growing business. But think about the problem, and when you're presenting any numbers, I would rather have a lower projection but more credible story, and see that the person has thought through his scaling up plan, than a hockey stick with no credibility. So don't sell hockey sticks. Think about what you're selling. And I would say last thing, really, I think quality of the team, again, I think which sort of brings us back to the earlier question. If there are ways you can sort of demonstrate quality of your team one way or the other, that's great. By the way, I never invest in companies in which the founder is paying himself anything more than a couple of 100,000 rupees, because that is not the kind of founder I want to go for. He has equity in the business. He's not in this for a salary. So, I want him to earn his money. So, for me, I mean, those are my thoughts. I know, Khurram, if you want to add something here from your perspective.
Sorry, I was on mute. No, I think Salman has covered most of the points, but just to be, quickly summarizing, there's 6 things that we generally rate when we are evaluating an investment. There's people, and then each one is a complicated sort of process map what we're looking for, and people we're looking for multiple founders complementing each other. We don't like sole founders, per se. Second is the product that they're building. Is it really solving a problem? What is the business model? How do they plan to make money with that? Number 4 is the size of the market. How big is the market? Does the business have the potential to make the kind of return that we're looking for? Number 5 is the traction that they have to date. Is it just a PowerPoint presentation and a big idea, or have they actually, taken some tangible steps to make it a reality? And oftentimes, it could be something as simple as just putting together a great founding team, right? 2 or 3 people from their peer group or their industry that they're planning to go after, and selling them and infecting them with the vision. The last one is potential for exit. What's our exit thesis out of that investment? Because otherwise, it's just a liquid investment that's never going to see the light of the day. So we need to sort of build a thesis around how is it that we are going to take that investment and get our money out, whether it's an M&A, trade sale, or an IPO of some sort, or some sort of a strategic acquisition. So those are generally the 6 things. I mean, each one has sort of subcategories that we look for. Under people, there'd be passion and knowledge of the market and things like that. And we could do a whole 1-hour session on what to look for when making an investment in early stage. So I don't want to take more time discussing that right now, since I'm sure we are short on time.
No, we'll definitely come back to you on some of those resources, whichever is shareable for the broader group. Khurram, what we'll love to end with is a bit of a small role play or simulation. So let's say we found a good, an angel investor found a good startup. They've made a syndicate. They have now decided to invest. They were in that pre-seed or early round, as you guys described, and they have now put in $25,000 of their money into something which was valued at $1 million, or just some random numbers. Could you just walk us through the steps? I think you mentioned a time horizon of anywhere between 3 to 6, 7, or even 8 years by the time the money can come out with 30x, 20x, 10x, whatever that number is. What to look forward to? Because many times angels are learning in every step something new, right? They may not know how the whole system works. So the question I'm looking for answers to, as you walk somebody very quickly through the journey of by the time the exit comes, is how should they keep track of where they stand in the cap table, because equity will get diluted as more and more funding rounds come. Sometimes they may be able to keep up, sometimes not. And this word exit, what does it look like? What is the actual mechanics of somebody getting their money out, whether it's 2x, 10x, or half x, whatever it might be? What does it look like on a more administrative level? Because we learned about how it's done when you're giving the money. How does it look like by the time you reach the stage of taking it out and then eventually taking it out?
All right, that's a fairly complicated and long answer to that question. I'll try to summarize it as quickly as I can. First of all, I think, as Salman alluded earlier, you need to diversify your portfolio. You need to have at least 10, ideally 20 investments. The more, the better. So either if you have the risk capital and maybe less than 10% single-digit risk capital to allocate this asset class, you could do this by yourself. Otherwise, I would advise creating a syndicate. And then a lot of what happens at exit and what kind of money you get back depends on what the syndicate terms are. What are you getting as an operator or a syndicate manager, and what the backers are getting? You're just putting money in. So again, that'll get complicated, but I'll just keep it simple for now. The second thing I would do is, generally when you invest at the angel stage, it's advisable that if you're putting in $1, you should have a reserve of $1 to participate in a subsequent round, because you want to ideally keep investing in your stars, the companies that are growing. That's how it's like typically when you even invest in public companies, you generally build up your position over time, right? So typically what happens in the journey is you write the first check. That's ideally 50% of the investment that you want to make in that startup, and then a subsequent round comes up, and you may want to participate, assuming it still conforms to your investment thesis. The risk is sufficiently mitigated, and you like the investors, you like the growth and traction and everything. Then you typically want to write a second check for $1 for the same amount that you typically put in the first round. And by that, until that time, you have a fairly good influence on what the cap table will look like, what your stake will look like. Any future financing, particularly when institutional investors come in, it's generally since they are putting the money in for the next stage of growth, the next spurt of growth, they typically dictate the terms. And oftentimes, as angel investor, you may not be on the board. Sometimes, there's no rule of thumb about this. Oftentimes, you would not be on the board. Somebody putting in $5 million might have a board seat because you don't want to, turn that into a 20% board also. And oftentimes, there could be multiple angel investors that the startup would raise money from. They could be raising $250,000 from 5 different angels, for example. So if they give the board seat to one, another 5 might expect a board seat as well. So typically, you don't have a lot of control provisions built into an angel check. And then the company will typically go through a process of maturation. As I said, each of the series will generally stack up the rights of each investor in that series. Sometimes they are stacked like a typical waterfall. Sometimes the rights are pari passu to all the previous financings that have happened. Sometimes you create classes out of each. So A, B, C get pari passu rights. D, E, F get the next high level rights. Your preferences generally are stacked that way. So it's very difficult to predict, what's going to happen. Generally, it used to be that there was a rule of thumb. Each round of investment would typically dilute you 20%, but it's not set in stone. But you can use that as a, very good indicator of the ballpark where your equity will end up. Founders, by the way, generally end up with, as a class, founders typically end up with less than 20% equity at the time there's an exit. And there's a lot of data and research backing that. I think there are exceptions like Mark Zuckerberg and Facebook probably had, 25, 26% equity. But generally the norm is that you're typically around 10% plus or minus a few percentage points when there's an exit. Next, depending on the amount of capital the angel investors have put in, you typically have, equity very as a fraction of one of the founders, right? And then, subsequent investors. So depending on how much capital the startup raised in order to get to that exit event, your equity in the startup will keep diluting. As a rule of thumb, if you just want to put a number and estimate around 20% in each financing round. And when the exit does happen, it's either a trade sale, which means somebody came in and bought you as a whole, in which case, again, generally your preference shares, because a lot of the times when investors are putting money in, they have preferences baked into the investment. So you typically issue preference shares. Your preference shares will convert into common shares in the company. And one of 2 scenarios will happen. Either you'll exercise your preference, let's say a liquidation preference, or you'll convert your preference shares into common shares, and then you get pari passu proceeds, with all the investors from that exit event. Or you could have an IPO, for example. IPOs are more complicated. Typically, later stage investors might have preference over whose shares get listed in the initial offering. But the good thing is you'll be able to trade your shares even if you don't have the right to participate in the initial public offering. You'll be able to trade it in the secondary market. Because the stock gets listed on the stock exchange, you can sell your shares. And then it could get really complicated. Depending on how the terms are and how the rights are stacked up for future investors. But generally, these are the mechanics. With some contractual or documentation related variances, I would say.
Well, thank you. I didn't realize the question was so loaded, and as we were navigating the list of questions, we sort of lost track of time a little bit. The topic is very interesting, and if I can see from the chat box, I think we did cover a fair bit. We'll make a hard stop now. Obviously, through Park Launch and other forums, people can always reach out if they have more questions, and hopefully in 1 hour we have covered what we aimed at, describing some tips and fundamentals, especially for newcomers in the angel investing arena. I'd like to thank Khurram and Salman both for your time, the preparation, and patiently answering all the questions. You guys, those who are not members at Park Launch, you're welcome to come and sign up. And there are a number of different groups. There are some questions about stock exchange as well in the chat box. We have multiple verticals across which different communities exist, which can then be used to have further discussions as you guys see fit and get connected to the right people. Thank you all very much for joining us today. Please don't forget there's another event tomorrow on a slightly different topic at Park Launch. This weekend we're holding 2 of them. And as usual, it was a pleasure talking to you both. Thank you very much and have a good day or a good night. Bye-bye.
Thank you, Amir. Thanks for having us. Really had fun. Khudafis.
Khudafis.
Bye.